Okay, in this lesson we are going to look at what is return on equity and how to interpret and analyze ROE of a company. Now, first of all, let us look at how ROE is calculated. ROE is calculated by PAT, which is profit after tax, minus preference dividend divided by average net worth. So when we are saying equity, we are referring to common shareholders of the company, and that's why you would see we are deducting preference dividend component while we are calculating ROE of a company. Now when we are referring to this PAT, we are referring to this PAT after minority interest. So I will say MI. Okay, so we are not looking at minority interest being a part of this PAT. Similarly, we will not include minority interest as a part of net worth when we are picking up net worth from the balance sheet. Now, what does it mean? ROE means the returns the shareholders get on the investments that they have made. Now, those are not exactly the returns that the shareholders will make, meaning that this entire PAT may not be distributed as dividend. But if you look at the returns that shareholders' money made after they invested in the company, that is what is represented by ROE of a company. So let us say if we say ROE of a company is 20%, so it means of the 100, on the 100 rupees the shareholders invested in the company, they have made returns of 20. Now what is the decent level of ROE, which ROE, like that may differ from industry to industry, so we will go into those details little later. Now let us look at how do you analyze an ROE of a company. To analyze ROE of a company, a typical way to go about is by using something called as DuPont analysis. Okay, now this is a very famous way of doing this analysis. Now ROE is given by PAT upon net worth. To further see how this ratio can be analyzed is by dividing this ratio into several other sub ratios by saying PAT upon sales into sales upon net assets into net assets upon net worth. Now this is called as NPM, net profit margin. This is called as net asset turnover ratio, so I will write turnover ratio, so TOR, and this is called as a leverage ratio or equity multiplier, so I will write EM. Now by using this ratio you can analyze entire P&L of a company. So let us see how we can do that. Now let us say, for the sake of discussion, let us consider over a period of time you identify ROE of a company is going down, and one of the reasons you identify is its PAT upon sales ratio is going down. To further understand why this ratio is going down, you can break up this ratio further into other two ratios like PAT upon EBITDA into EBITDA upon sales. Now you identify this ratio is going down. So if this ratio is going down, you can naturally see the factors like tax might have gone up, the other income component might have gone down, the interest expense portion has gone up, the depreciation portion has gone up, and there could be some extraordinary item which might have caused the ratio to go down. So when you're looking at this ratio, you can further look into this ratio as if this ratio is going down, one of these items is responsible for the decline in ROE of a company. Now let us look at the other ratio, which is EBITDA upon sales. To look at this ratio, we further divide this ratio into two other parameters, or into two other ratios. So the one of them is EBITDA upon gross profit into gross profit upon sales. Now if this ratio has gone down, so there could be two factors. One is selling and marketing expenses have gone up, or general and administration expenses have gone up. So if any one of this is the reason, you can further go into details of why selling and marketing expenses have gone up. Has the company adopted for new marketing strategy, whether the spending is going more on that front? General and administrative expenses have gone up, so is it that they have gone into new establishing of new plants where new staff has been recruited, whether some consultants were hired, was that expense one time, is it a recurring expense, so that you can really analyze what went wrong with general administration expenses and selling marketing expenses of a company. And if you see that gross profit to sales ratio has gone down, you get access to a direct cost component, like what has gone wrong with the direct cost, why labor cost has gone up, why fuel cost have gone up, why raw material cost has shooted up. So you can address all direct cost related issues by analyzing or by identifying if this ratio of the company has gone down. And this is how, by this ratio, you would see you can actually analyze the entire P&L of the company. Now this is about net profit margin ratio. Now let us look at sales to net asset ratio. So before we do that, I am just going to rewrite this all thing once again, so that we have little clean set to do this analysis or to understand this properly. So I am writing over here as ROE is equal to net profit margin into the ratio we were referring to, sales upon net assets, into the third ratio was net asset upon average of net worth. Okay, so by default, when you are referring to any of the balance sheet numbers, we should always do average of those numbers. Now sales upon net assets. Okay, so first of all, let us understand what are net assets. Okay, so net assets are typically total assets minus current liabilities. That is what are referred to as net assets. Okay, so now what is the interpretation of this ratio? Okay, this ratio is called as turnover ratio. It means if these were the levels of assets that were deployed in the company, how many times of these assets sales could be generated. So this ratio is typically in the multiples, so it could be 1.5 times or 2 times or 3 times. So higher this number, the better is for the company. Now as a part of analysis of ROE, you identify either ROE is going up or ROE is going down. That is a result of one of these ratios going up or down. So let us consider that we are saying that ROE of a company is going down, and one of the ratios responsible for that is sales upon net asset is going down. So how do you analyze that? Okay, so there are two aspects to analyze. One is the sales aspects and the other is the net asset aspects. So what it means is that the growth in sales has not been, or has been lesser than the growth in net assets. The simple analysis says that. Now it gives access to you to two parameters. One is sales and the other component net asset is what we'll look at later. So if the growth in sales is not happening as much as the growth in net assets, you can really look into marketing strategy of the company. So marketing strategy of the company could be missing, or may not be that efficient. Maybe the pricing is not that great, that's why the volumes of the companies are not increasing. Or you can also think of the differentiating factors, like typically what leads to higher sales for a company is the differentiators. So it is possible that company is not able to differentiate, because of which sales of the companies are not really growing up so much, or the aggressiveness of the management. So you can like, this is very typical thing, but you may observe that the management is not aggressive. So probably it is time for change of management for this company. Unless and until that happens, the sales of the company may not grow irrespective of how much investments you are doing into net assets. So this is what gives you access to the sales side of the story. Now let us look at this entire ratio and further try to analyze. So how does the picture look like? Okay, so when you look at net asset, it also contains a set of assets which we can categorize as operating assets. So let us say we will look at and bifurcate this ratio as sales upon operating assets into operating assets upon net assets. Now if you observe that this ratio is also going down, meaning there was sufficient investment into operating assets. Now what are operating assets of the company? Let us look at that. Operating assets of the companies are your net fixed assets. Now you need to ensure that you don't include capital work in progress in that, because that doesn't form part of your assets that are getting utilized right now. So you should include net fixed assets plus net current assets. Now when you're taking net current assets, you should consider or you should ensure that only normal cash component, okay, normal cash component of the cash items should be considered as a part of net current asset. Now how do you calculate normal cash component of your cash? So normal cash component, so I will say NC, is typically in the range of 2 to 3% of sales. This is a thumb rule. This is typical thumb rule that gets used across the industry. So whatever is over and above that is all excess cash. Okay, so you should ignore this excess cash portion when you're calculating net current assets. Okay, so basically your operating assets are net fixed assets plus net current assets plus operating investments. So typically investments that are into that have non-current nature, so those are the investments which should be included uh, as a part of your operating assets, and that too specifically in some other subsidiaries. Okay, any investments into financial instruments should not be considered as a part of your operating investments. So basically your operating assets are net fixed assets, net current assets which includes only normal cash component, and the third one is operating investments. That is what forms your operating assets. So if you identify that your sales upon operating assets uh, ratio is going down, it means the growth in operating asset has been higher compared to growth in sales. Now that tells to you probably irrespective of sufficient investments into operating assets, the sales are not happening. It means you are, as I said to you, that one of the pillars could be missing is from this angle. Okay, and you may also get access that probably there could be some glitches in uh, production area, so there is no sufficient finished goods available, like finished goods are not available when they are required. Maybe the product quality is not good enough, that the sales are not happening. And the second ratio that you can look at is operating asset upon net assets. So it is possible that this ratio is also going down, meaning that of the total investments or of the total assets or of the total money that has come into company, there is not sufficient investment that is happening as a part of sufficient is not happening in the operating assets. So what it tells to you is that there is a lot of money that is coming in the company, but that money is not getting invested into operating assets, but it is getting invested into probably some, so most of the money you may see that a lot of money may be part of investments. So a lot of money gets utilized as a part of investments, and so these investments are typically into financial instruments. So there is no proper utilization of the funds that are coming to company, and so one thing could be, and if you observe this over a period of couple of years, you can conclude that probably management is not in best position and how in terms of how to utilize the funds it has access to. And again you can think of that there is scope for change of management. Okay, now that could be a little far-fetched thought process, So what we recommend is that you can initiate a discussion with CFO of the company in terms of knowing why they are not utilizing the funds that they have access to. But this ratio can give you access whether the company is actually utilizing the funds that it has available, and if it is deploying them into operating assets or not. So if you look at the asset side, so you may see capital work in progress has shooted up and is not getting converted into gross block frequently, or as fast as possible. So you can see a lot of projects are not moving for the company. So that could be reason that operating assets are not growing, or a lot of funds are part of liquid investments, so the money is not getting put into 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 assets which can produce more sales for the company, and as a result of that you will see that sales upon net asset ratio for the company is going down, resulting into reducing ROE of a company. So that is how you can understand how sales upon net asset ratio is impacting ROE of a company. So that was about net asset turnover, and now let us look at the third ratio, which is net asset upon net worth. Before that, I will just clear off the screen and I will just rewrite the initial equation that we began with. So we began with ROE is equal to net profit margin into asset turnover ratio into average, so average net assets upon average net worth. Okay, so I'm just, for sake of discussion, I'm just referring to net asset upon net worth. So net assets can also be written as capital employed upon net worth, which is total debt plus net worth upon net worth. So this is 1 plus total debt upon net worth. So basically the ratio is 1 plus debt upon equity. So if you replace this ratio and put it as a part of this entire equation, you would observe that if debt of the company goes up, ROE of the company goes up. Now that is the concept of financial leverage. Okay, and you would observe that we would share more details of that in the upcoming video. This much for now. That is how you can analyze the balance sheet, the ROE of a company. Thank you.